In this video, we'll be comparing cash, the Global X High Interest Savings ETF, versus SPLT, the Brompton Split Corporation Preferred Share ETF, given the current rate environment we are currently in Canada. So as you may already be aware of, the Bank of Canada just cut rates by 50 basis points in October of 2024 from 4.25% to 3.75%. And basically this means that any high interest savings ETF or high interest savings account that you might have with your bank is going to be paying out less and less yield. So this yield of 4.19% for cash currently is going to dip below 4%, and we're going to be at a 3% range. So you might be looking for alternatives to invest in instead of cash, given that you're going to be earning less and less monthly income as the Bank of Canada continues to slash interest rates in response to lower inflation. So cash pays out interest income, and it is taxed at the highest rate when we look at the different types of distributions. Interest is taxable on about 50%, versus dividends are only taxable on about 34%. And obviously, capital gains 25%, and return of capital is non-taxable since it's just your own money coming back to you. With cash, you can see here in this chart from the 2023 summary of distributions that the majority of it came from interest income, and a very small fraction came from return of capital, which is going to be non-taxable. So in the majority of it is interest, and you're going to be paying a lot of tax on those distributions. When we look at a fund like SPLT from Brompton, the distributions that it provides, if I go here to, for example, 2023, the distributions that it provides are about half eligible dividends and the rest return of capital. So about 50% of the distribution that it provides is going to be return of capital, so it's completely non-taxable. And then the other half is going to be dividends, which are much more favorable compared to interest. So that is definitely nice from a tax perspective. But also the yield on SPLT is much higher than cash. So cash is going to continue decreasing with the interest rate cuts below 4%, as we mentioned earlier, while SPLT is over 6%. So how is SPLT able to generate such high monthly income? So what it boils down to is a split corporation has two shares, a Class A share and a preferred share. The preferred share acts as the debt for the Class A share, effectively leveraging it. So if in an ideal world, if there was a preferred share for every Class A share, the split share would be leveraged 100%. That's not always the case. Not that people buy preferred share ETFs, but not in the volume that people do Class A shares. So the leverage is generally less than 100%, probably around like the 70 range. We don't know for sure. Depends on each split corp individually. So, but when you buy the preferred share, you are essentially being the debt for the Class A share, and there are very little price fluctuations that happen with the preferred share. And in return for doing this, you receive all of the dividends that the underlying portfolio of stocks from the Class A shares generate. So a lot of these split corporation Class A shares are investing in high quality dividend paying companies such as DFN, DGS, LBS. They're all investing in like the big six Canadian banks, energy companies, high telecoms, high dividend payers. And in return for investing the preferred share, you get to collect all of that dividend income and have very little risk in terms of your price appreciation. So it's not to say that there isn't any risk in terms of price appreciation. Preferred shares can go up, they can go down. However, they are way less volatile than the underlying stocks. So it does have a very low risk rating. So plotting SPLT and cash inside of Koyfin, we can see that since SPLT's inception date back in June of 2023, SPLT has outperformed cash quite substantially by over 8.5%. So what's the verdict for my portfolio? So after I heard of the interest rate cut that happened this week in Canada, it was the nail in the coffin for me to switch out of cash that I had been holding for quite a bit as my emergency fund to SPLT instead. So now with that change, I'm actually receiving over $16 more in monthly income. With cash, I was at $35 a month, and now with SPLT, I'm over $50. So it was a nice increase in monthly income for me, bringing my monthly income as of today with VDY's distribution right now to $474 a month. So and cash was just going to keep decreasing given that this news was going to go below $30 a month for me. So as it keeps decreasing, which I do anticipate there's going to be more cuts from the Bank of Canada in the future, um, that you're going to get more and more into territory where you're losing out to inflation. So for me, it was the nail in the coffin. I decided to switch out of the cash and buy SPLT instead inside of my emergency fund. So is this decision going to be for everyone though? Um, Absolutely not. Cash, you have guaranteed safety with cash for the most part, as long as the banks don't go insolvent. So, um, you have a lot of comfort in that decision because, it's not going to. There's no price fluctuations. It's not going to go down. It's also not going to go up. It's always just going to keep, going up, down, up, down, up, down as it pays out the interest each and every month. So, but with SPLT, you have the chance for capital gains, but you also have the chance of losing a bit of money if it goes down. But for me, I am comfortable with that risk. I understand how split share funds work, and um, you know, I'm comfortable with the risk. I wanted additional and monthly income, and so I switched my emergency fund out of cash to SPLT. So not going to be the decision for everyone. Um, you can think of, losing out to inflation with cash as the insurance you're paying to have an emergency fund that isn't going to go down. Uh, but with SPLT, I'm comfortable with that risk. I'm pretty confident in my decision. So that's what I ended up doing. you know, just giving you guys a different perspective, different alternatives, given that the interest rate is going to keep decreasing. So definitely consider it as an option. Take everything that I've presented with you today and making a decision and do what's best for you. So with that, I'll like to thank you for watching this video. If you like the video, please like it and feel free to leave a comment. And if you can subscribe, that would mean a lot to me. So thanks for everything, and I'll see you guys in the next video.